Jake Claver was handed the easiest layup in crypto media. Someone asked him about 30,000 XRP. All he had to do was say a year, any year, 2027, 2030, the next cycle. He would have been quoted, clipped, screenshotted, and turned into thumbnail fuel for the next 6 months. He refused. He gave the math: 30,000 XRP, $1,000 per token, $30 million, the ultra-high net worth threshold that roughly 0.00001% of the global population currently occupies. And then he stopped talking. No date, no quarter, no cycle prediction. Just the number, and then silence. And that silence is the part nobody in this space is decoding correctly. Because the silence isn't hesitation. The silence is a checklist. There are 3 specific structural conditions that have to clear before the $1,000 figure becomes readable on a calendar, and only one of them has even started moving. What I'm about to walk you through is not being explained to retail investors the way it should be, because the people who understand it are too busy positioning to talk about it. Let me pull back the curtain. Today, we decode what Jake Claver actually said, what he deliberately did not say, and the 3-link chain reaction that has to engage before any $1,000 conversation moves from arithmetic to timeline. Before we go under the surface, nothing here is financial advice. This is a structural read of the public record, the regulatory sequence, and the institutional positioning data. Your decisions belong to you and a qualified professional. What this channel offers is the calm read. What you do with it is yours. Let's start with the hard truth. 90% of the commentary on Claver's interview is staring at the wrong number. They're staring at $1,000. They're debating whether it's possible, whether it's hype, whether it's a moonboy fantasy. They're arguing about the destination while completely ignoring the road. Here is the mechanism almost no one is explaining. A price target without a timeline is a structural threshold. A price target with a timeline is a prediction. These are not the same thing. They are not even in the same category of statement. The first is testable against conditions. The second is testable against a calendar. Calendars destroy creators who name them. Conditions do not. Claver was not refusing to commit. He was refusing to lie. And the honest answer to when does XRP reach $1,000 is when 3 specific structural conditions clear in sequence, and not one day before. Here are the 3. Memorize them, because every piece of news from this point forward either advances one of them or it does not matter. Condition 1. The Clarity Act becomes statute. The market structure bill currently moving through the Senate is the regulatory key. The Torres ruling and the Second Circuit affirmation gave XRP judicial clarity. Judicial clarity can be appealed. Statutes are harder to unwind. The largest institutional allocators, the ones whose capital base could actually move XRP toward 4-digit territory, position on legislative clarity, not judicial clarity. Until the Clarity Act reaches the president's desk, they are in. But they are not in at full size. That gap between positioned and fully positioned is the first checkpoint. Condition 2. Real-world asset tokenization reaches operational scale. Sandy Call of Franklin Templeton said it on camera. The institutions are not trying to recreate the financial system. They are trying to redesign it. Recreation means new infrastructure for old products. Redesign means new products on new infrastructure. The XRP ledger sits on the short list of chains being tested for that tokenization layer. Until those tests move from pilot to live operational volume, the demand pressure that drives a 4-digit price has not arrived. It is being built. It is not yet flowing. Condition 3. Banks deploy beyond testing. This is the single most overlooked data point in the entire space. Banks have been testing Ripple's settlement infrastructure on private ledgers for months. Testing is not deployment. Deployment is the day a bank moves a customer transaction across that infrastructure and books the result on its balance sheet. Before that day, XRP's price is anchored to speculation. After that day, it is anchored to utility. 3 conditions. 1 has barely started. The other 2 are in motion, but not complete. That is what Claver knew when he refused to give a date. Let's do the math the retail crowd ignores. The headline arithmetic is uncontroversial. 30,000 multiplied by 1,000 equals 30 million. Nobody disputes the calculator. What people dispute is whether the price can arrive there. So let's stop arguing about the destination and price the road. XRP's total supply is capped at 100 billion. Circulating supply sits in the range of 55 to 57 billion. But circulating supply is not the same as float. Float is what is actually available for an institutional buyer to acquire without moving the market. Subtract the XRP held in Ripple's escrow. Subtract the long-term cold storage positions held by holders who have not moved a single token since 2017 or 2018. Subtract the XRP committed to active liquidity corridors by Ripple's institutional partners, capital that is technically circulating but operationally locked. What you have left is a float that is a fraction of the headline supply number. Now layer the demand side. The Coinbase and Parthenon institutional survey released this year polled 351 institutional investors. 18% already hold XRP. 25% more plan to add it within the year. That is a 43% combined institutional position. These are not retail wallets. These are balance sheets. And the survey was conducted before the Clarity Act vote, before tokenization moved to scale, before banks deployed. Think about that math. Institutional positioning is being built ahead of the three catalysts, not after. Retail buys after the news. Institutions buy before. And 43% of 351 institutions are buying before against a float that is a fraction of the headline supply. This isn't a prediction. This is the logical mathematical outcome of demand exceeding compressed supply once the catalysts engage. If you have a problem with these numbers, you don't have a problem with me. You have a problem with the laws of supply and demand. While retail investors are panic selling red candles and debating whether $1,000 is fantasy, the institutional signal has never been more readable. Greg Kidd, the 10th employee at Ripple, was asked about price. He gave two words: liquidity and supply. No targets, no multipliers, just the mechanic. When demand exceeds supply, price rises. That is not opinion. That is plumbing. Sandy Call of Franklin Templeton, a firm managing $1.5 trillion in assets, said the institutions are redesigning the financial system, not recreating it. Ask yourself this brutal question. Does a firm of that size move without absolute legal certainty? Absolutely not. They don't gamble. They position, and they are positioning on the XRP ledger as one of the candidate rails for the tokenization layer. This isn't retail FOMO. This is calculated positioning by market makers, custodians, and treasury desks who know exactly what the three-condition sequence looks like from the inside, because they are the ones building it. The 43% institutional allocation figure from the Coinbase Parthenon survey is the smoking gun. It tells you the smart money is not waiting for the catalysts. It is positioning before the catalysts so that when the chain reaction engages, they are already in place and the entry is not available at current prices anymore. Here is the part most analysts get wrong when they list the three conditions. They list them in parallel. They are not parallel. They are sequential. They are a chain reaction. The Clarity Act unlocks the regulatory certainty that allows the largest tokenization deployments to move from pilot to production. Production tokenization is what gives banks the operational confidence to move live customer volume onto the XRP ledger instead of testing it on internal ledgers. Each link opens the door for the next, which means the timeline is not three independent events on three independent calendars. It is one chain reaction, waiting for the first link to engage. You cannot date a chain reaction. You can only describe its conditions and watch for the first link. The first link is the Clarity Act. When that statute passes, the second link engages within quarters, not years. When tokenization moves to operational scale, the third link engages on a similar compressed timeline, because the bank deployments are already built and waiting on the regulatory and infrastructure conditions to clear. When the chain reaction engages, the wait-and-see capital becomes all-in capital, and it does so against a float that is a fraction of headline supply. We are moving from an era of abundance to an era of scarcity, and the survey data proves it is already happening. The XRP, held in long-term cold storage since 2017 and 2018, is not coming back to market for a 10% bounce. It is gone. The XRP committed to institutional liquidity corridors is not freely tradable. The XRP, being acquired now by the 43% of surveyed institutions, is moving from exchange wallets to custodial vaults. And once a token enters a multi-sig institutional vault, it does not return to the order book for a quick profit. It is removed from float. The institutions have spent years positioning quietly while retail debated whether the lawsuit would resolve, whether the regulators would clarify, whether the banks would deploy. The lawsuit resolved. The regulators are clarifying. The banks are scheduled to deploy. And the float continues to compress every single day that institutional positioning advances ahead of the public catalysts. When the Clarity Act passes and the first link in the chain reaction engages, the risk premium that currently sits on XRP's price vanishes. The price gaps. And the gap does not gap to a level where retail can comfortably accumulate whole tokens at leisure. The gap closes the window. That is what Claver's silence was protecting you from. He was not refusing to give you a number. He was refusing to give you a false sense of time. I know it is tough watching the price chart while the structural conditions advance invisibly. I know the headlines create noise. But as an analyst, I am trained to distinguish noise from signal. You held through a court case. The court case ended. You held through the appeal. The appeal ended. You held through the long silence between rulings when no one knew which way it would resolve. The silence ended. What you are holding through now is not silence. It is construction. The legislative framework is being drafted in real time. The tokenization rails are being laid by firms managing trillions. The bank deployment schedules are being finalized in meetings you will never see minutes from. You are not waiting for permission anymore. You are waiting for completion. The destination is not the question. The destination is mapped. The variable is the speed of arrival, not the direction of travel. Being early feels exactly like being wrong, right up until the moment the chain reaction engages and reality catches up to structure. The headline reads $1,000, XRP. The structure reads 3 checkpoints, 1 chain reaction, a 43% institutional positioning curve bending ahead of the public catalysts, and 1 analyst who was honest enough to give the math and refuse the date. Price is a distraction. Structure is the reality. Jake Claver said more with his silence than most analysts say in an hour of price predictions. He told you the math is real, the calendar is not yours to know, and the position is yours to hold. The question is not whether the price arrives. The question is, who is still holding when the first link engages and the chain reaction becomes visible to everyone who is staring at the chart instead of reading the checklist? If you made it to the end of this breakdown, comment chain reaction below. I want to see who actually understands the sequence. Stay patient, stay rational. The math doesn't lie, and the structure is almost complete.